In my experience, working with hundreds of retirees, there always seems to come a point where it makes sense to downsize. Sell the family home, free up some cash, and simplify life heading into retirement. But when it comes to selling your largest asset, you need to be very careful. I've seen the heartbreak when families get this wrong, and it can cost tens, if not hundreds of thousands of dollars. Don't get me wrong, the Downsizer contribution is one of the most powerful tools available to Australians approaching retirement. But in saying that, it only works if you use it properly. So in this video, I'll walk you through how to implement this strategy, but more importantly, I'll let you know the most common mistakes people make and how to avoid them so you don't pay a high price later on. Before we get into the detail of the Downsizer contribution and how it works, it's worth asking the bigger question. When do you know it's time to sell your home in retirement? Our home is one of the largest financially, but also the most emotional assets we own. So many memories, so much of our childhood is linked to our home that it can be an incredibly difficult decision to make, to downsize, to upsize, to move. And so much of this is related to the networks that we have in retirement as well. But sometimes it's incredibly obvious, and other times it can be financially driven, and that can be difficult to deal with and difficult to understand the impact of while you're trying to make that decision. So many of us in Australia have a large portion of our wealth tied up in our home. People can be giving up a much better livelihood and a more relaxed and more flexible and less stressful life by releasing the equity that sits within the home. And in a lot of cases, so much of that equity is doing nothing, and being an illiquid asset, you can be giving up on the spending that is able to be held on the other side. So if you think about it, and here's an example that kind of brings this home. If you have a $2 million home, but say only $500,000 in assets, you could be on the maximum age pension and getting, say, $45,000 as a couple, because your home isn't included in that assessment. But if you were, say, downsize your home and buy a smaller home or a home in a different location and release, say, $1 million, you could potentially double the income that you're receiving. So that $45,000 could increase significantly and allowing you to live a completely different lifestyle and have access to larger portions of capital. So if you want to travel in retirement, you want to spend, if you want to upgrade your car more often, do all these things, then it can be incredibly powerful to make this downsizer decision and increase that flexibility, but it can be an incredibly difficult one to make sense of. Another thing I want to mention here is that health is an important part of the downsizer decision as well. Many times we've seen people living in large houses with empty rooms, the old empty nest story, or they have gardens that require hours and hours of tending, and it isn't always conducive to a relaxing and enjoyable retirement with these links and these tasks and these jobs that need to continue. And similarly, there's many houses, old houses in Melbourne and in other major capital cities that have poor layout for those in retirement. They aren't conducive to older or even younger people. Bringing forward the decision can be better than waiting until it's too late. And this is particularly common these days where we have multi-level dwellings, we have stairs for those people that are starting to get longer into their retirement. But let's get to the actual detail and the financial matters and why the downsizer contribution can be so valuable and so useful. What is the Downsizer contribution? It's an incentive by the federal government to encourage people to change houses in retirement. Essentially, they're encouraging people to extract equity and therefore giving them the ability to contribute more into superannuation. And the Downsizer contribution applies outside of the normal total super balance cap, which is now $2 million per person. How does it work? In order to make a downsizer contribution, you have to meet a few areas of eligibility. Firstly, you have to be over 55 years of age. Your home must have been used by yourself or your spouse for the last 10 years or more, and that 10 years is measured from the settlement date of purchase to the settlement date of sale. It cannot be a caravan, boat, or mobile home, so no barbecue boats included in this, and the proceeds of the sale must be exempt, or at least partially exempt, under the capital gains tax exemption that applies to principal places of residence. The details and how do you execute a downsizer contribution? You can't have used a downsizer contribution before, so you can make up to $300,000 per person, but you can only do it once in your lifetime. It must be made within 90 days of receiving the money, and extensions are incredibly rare. They're usually only due to uncontrollable circumstances, and you have to apply to the ATO to get an extension. Most importantly, when it comes to the details, you don't need to be below that total super balance cap. So even if you've got $2.5 million in superannuation, you could still put $300,000 outside of that cap. You just have to do it via the downsizer contribution. It has to be from the proceeds of the sale. How do you do it? You deposit the money into your superannuation account, and at the same time you lodge a downsizer contribution into Superform, a NAT 75073, which we'll show on screen. This has to be done either before or at the time of making that downsizer contribution. Now, we've gone through the very basic eligibility, but there are a few areas and a lot of frequently asked questions that we get that help to understand the different ways you can use this contribution cap. One example, let's say Kate and Tom sell their home for $600,000, but only Tom's on the title. In this case, and in every case, if they're spouse and partners or married, Tom and Kate have both met the requirements of the downsizer contribution and can both make up to $300,000 each, even though only one of them is on the title. The next one, and this is incredibly important to be on top of, a couple, say Flynn and Betty, sell their home for $400,000. They cannot contribute more than the value of their home, being that $400,000, as a downsizer contribution, but they could split it up between them. So if one of them has a lower balance, say Flynn could contribute $300,000 and Betty could do $100,000, or the other way around, but it has to be below the total sale proceeds they get from selling the home. Another loophole, and this probably comes down to more relevant to those with our self-managed super funds. Let's say Joseph has a portfolio of listed shares worth $150,000. Joseph sells his house for $500,000, and because he meets all the other requirements, he can make a downsizer contribution of up to $300,000. In this case, he can actually contribute $150,000 as an in-specie contribution, so transfer his shares into the self-managed super fund, as long as the deed of the self-managed super fund allows it, and use that and claim the downsizer contribution as being that transfer of shares, instead of using cash from the sale of the contribution. So he could keep the cash in his bank account and transfer the shares as that contribution instead. There would be a capital gains tax event on selling those shares. It would have to be realised at the time. Another one, an important one that we get a lot of questions on quite regularly, is whether you can sell part of the equity in a property and still claim the downsizer contribution. The key here is that you can only do it once. So let's say, for instance, a couple sold 20% of their home that was worth $500,000, being $100,000 they got in proceeds. They can make a downsizer contribution up to that maximum amount of $100,000 between them. But if they decide to sell more of their home in the future, they will not be able to claim the downsizer contribution again, because you're only allowed to use it against one disposal of an ownership interest in your home or in your spouse's home. Now, what happens if the contribution is invalid? So if it's received after the 90-day period, or if it's in excess of the total proceeds, you need to be aware that if it doesn't meet the eligibility requirements, it's likely to be covered by the non-concessional or concessional contributions caps, which may trigger excess concessional contributions, which may trigger penalties, taxes, and interest. So you need to follow the paperwork incredibly carefully and meet all those requirements on the way through. So once again, I hope this video helps people navigate this, what can be a difficult time during their retirement, and please feel free to share questions, feedback. If you're looking to understand how a downsizer contribution might help you in retirement, please reach out to Waddle and our team, and please subscribe to our channel.